Hi everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be talking about how to build your credit score. In today's video, I'm going to give a brief description of what a credit score is, and then we're going to go over the 5 factors of what comprise how your score is calculated. I do videos on personal finance, investing, as well as stock analysis, so if you like this type of content, please consider subscribing. Also hit that thumbs up button, it helps me out a lot with the algorithm. Now to the content. Now the credit score really originates from lenders needing a system to understand who is a good person they should let borrow money and who is someone they should maybe stay away from. So the credit score is this number between 300 and 850. The higher that score is, the better your credit score is. So lenders are more likely to lend that consumer more money over someone who has a lower score. Also, this is something where rates can be affected. So if you have a lower score, the lender is more likely to charge you a higher interest rate than a consumer that has a higher score, because they're more likely to get paid. They can their risk is lower and they can charge a lower interest rate to different consumers. All right, so first off, we have payment history at 35% of the score. The reason why this one is the highest as a percentage is because lenders want to know, are you going to pay what you owe them? So this is definitely a huge percentage, over a third of the total score. Now, accounts that factor in, could be credit cards, mortgages, car loans, retail accounts. Some negative hits against this payment history are bankruptcies. I believe that stays on 7 to 10 years. Lawsuit, wage attachments. This could be things that are attached to, when you get paid, things that are being taken out. Could be IRS, could be maternity, paternity type lawsuits, garnishing against your wages. And then simply the way to improve your credit score in this manner is to always pay on time. So just make sure you're paying what you owe in your credit cards, your mortgages, whatever it may be. If you owe money, make sure you're paying it at the end of every month or whenever it's due. And then if you are behind, make sure you get current on what you owe and then stay current and don't deviate. Always pay what you owe, and this will help this score. Can't stress enough, this is the number one here, 35% of the score. All right, so second on the list is amount history. It makes up 30% of your total credit score. And how do you approve this? So one thing is credit utilization, and specifically on your credit cards. For example, if you have a credit card that has a max of $1,000 on it, you want to keep your credit card utilization at below 30%. So in other words, if you have that max of $1,000 on your credit card, you only want to spend or have on there max $300. That keeps your utilization under 30% and will help improve your credit score. Now you may ask, what happens if I take out a car loan and I owe $10,000 on that car and I've been paying it down, but I'm still have amount balance of $8,000 out of $10,000? Like, let's say that's the case. Well, they're not using that utilization per se, but what they are tracking is the payment history over time. So I wouldn't be too worried about loans, but more about lines of credit and keeping those lines of credit fairly low as a percentage of the total line of credit amount. So you want to keep that below 30% for sure. Thanks for watching thus far. Please hit that like button. It helps me out a lot with the algorithm. Now back to your content. All right, so third on the list and 15% of your total credit score is your credit history. Now, things they consider in this is the age of the credit and your average age of credit across all lines of credit. So it could be your mortgage, could be student loans, could be credit cards, anything else that is you have a loan out there for, or you have credit borrowed against for. Now, the reason why this is important is because lenders really want to make sure that you have a good, solid history of paying back other lenders. So if they don't see that history, you're a little bit more of a risky investment. However, they don't have this as a huge weight, as there are a lot of new people coming into the market every year that almost have a 0 credit score. And so that credit history, while it's not as big of a factor, it does play into, if you want to get into the 800s, higher 700s, you really need to start building a credit history in order to start getting into those higher credit scores. All right, so coming on fourth on the list is credit mix. That makes up 10% of your total credit score. Now, credit mix is how many of the different types of lines of credit do you currently have? They like to see something broad. So if they see you making payments on mortgages, credit cards, student loans, they're consistent across the board. They've been paying back on multiple different types of loans, and they're more likely to give you, feel like you're a better suitor for different other types of credit. So as I mentioned before, those are the common types. But one of the things I want to stress here is you don't need everything. You don't need all of them meaning you don't have to catch them all like in Pokemon in order to actually have a good credit score. You just need a few, I'd say 2, maybe 3 max in order to have a good build up a credit mix as well as a good history. And again, this is only 10% of the score, so don't be taking out different lines of credit just because of this credit mix one here. You definitely want to make sure that you're abiding by payment history, amount history, more so than this one. All right, so new credit is number 5 on the list, and it makes up 10% of your total credit score. Now, simply, this is the number of new credit lines that you've applied for within a short period of time, or hard credit inquiries. So you just want to be careful of this, especially when you're going out and making a big purchase, such as a home. This hit to your credit could possibly be the difference between having a better interest rate on a home versus a higher interest rate, which could price you out of certain purchases. So you just want to be very careful of that and mindful of it. The easiest way to increase your credit score on this one is essentially don't open any new lines of credit before you're going to make a big purchase. It basically, you just want to keep your credit constant, and this will definitely build up on its own. So I would say a softball down, fastball down the middle. You can knock it out of the park. Just don't open any new lines of credit on top of the ones you have, especially before big purchases such as a home. If you're trying to get the biggest impact on your credit score and you say, what should I do? Well, I would say focus on your payment history and your amount history. The amount history is, remember, that credit utilization. Between your payment history and your amount history, that makes up 65% of your total credit score. So in between those two, if you just focus on them, you can get 2/3 of your credit score in line. So again, just make sure you're making payments on time, and then your credit utilizations means out of your total line of credit, you want that under 30%. So in the example we gave earlier was if you had a $1,000 line of credit, you want to make sure you keep the used credit on that less than $300 or 30%. So between those two, it makes up 65% of your credit score. Definitely make sure you address those two. It will definitely give you a bump to your credit score. And the other two things that just take time is your credit history. So from the time you open up an account, they just need to see history on that account. There's nothing you can do to accelerate that other than just keep paying and keeping that line of credit open. On the credit mix, I wouldn't open up new lines of credit just because you can, unless you know that you're going to keep it for some period of time and it's going to be actually benefit to your financial situation. On the new credit, this is something that is just easy to do. Don't open any new lines of credit. It's an easy 10%. It just means that you're not opening anything new, and you don't have to worry about your payment history or your amount history changing in the near future. If you like this type of content, please consider subscribing. Hit that like button. Thanks so much for watching today. Frank Finance,